Yeah, good morning, everybody. Welcome to the morning show. It's the best morning show in finance here on Stock Market TV. Spencer Israel, JC Parets, and Steve Strazza is still in Asia. Is he ever coming home? I'm honestly not sure. He's in Hong Kong right now, so we had to go and get ourselves a guest host for the day. I'm not going to spoil it, but if you just scroll down and look in the description, you'll see who it is. So we'll bring him on in a second. A lot going on this morning. Obviously, we're like in the heart of the earnings season here, so that's why I'm in a good mood. But we got a lot of charts here to talk about, like a lot. The slide deck is full. We have our guest charts as well. A lot going on today. Kimmy Sokoloff will be on the show today. I can tell you that as well. Good morning, everyone in the chat. Good morning, Joe, Ken, Hot Pepper. I don't know if I've seen you before. What's up, Hot Pepper? How are we doing this morning? Let's get the show on the road here. All right, JC. Should we bring on our guest host?
Bring him on.
Bring him on,
Mr. Gordon. Surprise.
Mr. Todd Gordon.
What's up, boys? Good morning.
See how I did a little shimmy before we bring you on? That's how you know I'm excited. JC's got that morning shimmy going.
Oh, my goodness. Middle of earnings season. Market's busy. I don't think we're going to have much of a summer, boys.
Dude, let me tell you something. This Spencer Israel character, this guy loves his earnings, man. I never see anything like it.
Talking about me?
I avoid earnings like the plague, and this guy's like a moth to a flame over here.
Yeah,
it's pretty awesome. I'm running I'm focusing on individual equity, so I'm kind of heading that direction as well. I've been known to pick up 10Q, 10K, look at some financial statements myself. So looking forward to it.
But Todd,
and you have trouble sleeping, you said? This seems to be like the perfect recipe there for a good night's sleep reading that shit.
It's pretty awesome. Talk to me, Spencer.
I'm trying to explain it to JC. It's not so much about like the earnings. Sometimes it is, but also just about the volatility, right? It creates movement.
The way I look at it with fundamentals, earnings or macro or data, whatever. It's not the data itself that you're going to act upon. It's the market positioning ahead of time. It's the anticipation. The data point comes out, and it's the reaction to it that matters. Like, I don't care what the stimulus is. That's probably a better word for it. But whatever is something that the markets are focusing on, the anticipation, the reaction for me is very telling.
Yeah, I don't care whether Netflix beat or missed on the top or bottom line.
Right.
I just care about what the market thinks about it, right?
100%. Yeah. Yeah.
JC, I think we're all in agreement there.
Are you guys still talking?
All right. Okay. JC's been writing and talking a lot about bonds. Let's start with state of the markets, and then we'll get to some of the earnings here. We won't do it right off the top here like yesterday. So state of the markets. JC, you ready?
I was born ready, baby. Let's go.
Let's do it.
All right, here we are, a little state of the markets action. I don't want to get too deep into the bond market. I brought it up a couple of times over the last week, but bonds have been moving already. And what's really interesting, guys, is that the way the bond market is setting up currently is very similar to the way the stock market was set up in the fourth quarter. Very, very high short interest. These perma bears, rather than covering their shorts throughout a very, very deep decline in technology and other growth stocks around the world, rather than covering their shorts, they added to short positions, these idiots, to the point where they came into 2023 the most short they were the entire time. And granted, there were some short sellers that covered their shorts last year, of course, but that doesn't matter. What matters is, in aggregate, not only did they not cover their shorts, they were actually increasing their short positions as the year progressed, and they came into 2023 the most short ever. And what happened? Best start to a year of all time, right? Classic. It's not that fundamentals changed. It's not that the economy's better. It's not that Powell, as it turns out, didn't ruin everything. It has nothing to do with that. Stocks don't move based on fundamentals. Stocks don't move based on earnings. Stocks don't move based on economics. Markets move based on positioning, right? Or mispositioning, really, in the case of the stock market this year. Well, the bond market is in a very similar state. And you might be saying, well, JC, I don't trade bonds. Yeah, you know what? Neither do I, right? Every now and then I'll have a TLT trade or something like that. But that's the exception, not the rule.
That's the key driver to this market. You have to, if you don't care if you don't trade them, you have to know not only where those longer yields are, but you got to watch the shorter yields, which is Fed policy. You know, that's what's driving this market. It's so important. I totally agree.
And let's remember that the Fed doesn't drive policy, supply and demand does, and then the Fed does what the market tells it to do. So it's not the Fed doing anything, it's the market as the leading indicator, and then the Fed doing whatever the market tells them to do. So let's keep that in mind, number one. Number two is that even if you don't trade bonds, it's important to remember this is a $130 trillion market. $130 trillion. What that means to you is that every cryptocurrency in the world can go to zero tomorrow, and it won't matter to anybody who matters. All of these pot stocks can go to zero tomorrow, and it won't matter to anybody who matters. The bond market is what actually matters. 130 trillion. The stock market in the United States, just to put things in perspective, is like 40 trillion, a third of the size of the bond market. Not to mention all the leverage that you get in the bond market, but that's another story. Large speculators, quote unquote, the dumb money, historically, when large speculators are at consensus, consistently it pays to take the exact opposite side of that. And right now, large speculators have on their most aggressive short position in the bond market ever, betting that bonds are about to collapse again right after they've already collapsed, and betting that interest rates are about to skyrocket higher right after they just had their biggest rate of change increase ever. So now they're betting on higher rates. Now they're betting on lower bond prices after we already got those moves. I like the other side. And if you are not trading bonds, and I'm not really putting on a bond trade right now myself, as investors, as equity investors, which Todd Gordon is, of course, and myself as well, and a lot of you, think about the types of stocks that should be doing well in an environment that rates are not going up, but actually going down. And maybe, just maybe, Mr. Gordon, that is why technology and growth stocks, go to the next chart, technology and growth stocks have been doing so well, already pricing in the fact that rates are about to collapse and bond prices are heading higher. And listen, I don't know what's going to happen. My crystal ball's in the shop. But when I see the dumbest money in the world betting this aggressively on something happening, I'm going to look a little closer and see if we should be putting on bets of the exact opposite thing happening. How do you feel about that, Mr. Gordon?
You know, I don't know if it's, well, that's what I love about the market. You said everyone came in extremely so short, underweight. And I feel, you know, I've read reports in terms of like making 2 points ago what you said, adding to short positions and fixed income. Okay. Well, a lot of people came in underweight or short equities this year. And I've just started reading reports that retail now is getting wind to it. We're seeing increased call activity on the retail side, but yet institutions out of that Bank of America fund manager survey, they're still underweight equities, which is crazy. Second point you said, yeah, we're not trading rates. We're not trading fixed income. You know, I put a TLT trade on, me too. But if you have a long expression in growth and specifically tech, consumer discretionary, and less communications, you are in sort of a second derivative, you are trading interest rates because,
but not this year is my point, right? Something's up. Someone's got to give, no?
Well, I'm kind of biting my tongue before we jump into this conversation, and it's something that we're talking about as you get over 40, your sleep patterns change, maybe having something to do with twins, JC, which very few people understand.
By the way, shout out to anybody out there who's got twins. Spencer Israel, earmuffs. The less you know, the better. But for Todd and me who have twin boys, man, God bless you guys. We're family. We're all family.
Oh, it's crazy. It really is a fraternity. We can get into that later too. But like, you know, so I want lower yields, and I have some charts. We can bring them up later on. I want lower yields as it will continue to rotate in growth relative to value. But the problem is what we were mentioning, looking at long-term rates versus short-term rates. If we get what we want, if those fixed income shorts, which I agree are late to the party, if we get what they want and they get squeezed, longer term rates drop, that will continue to rotate in growth, which is awesome. But unfortunately, then we have to look at where it puts the yield curve. And the yield curve is the one thing that, even the oldest minds, not the brightest minds, let's say the oldest minds on Wall Street, are still not able to explain to us. We have significant yield curve inversion.
The more confused they are, the better.
100%. I love it. Yeah, right. So I can't wait to see the resolution. I have some thoughts on it, but again, you got to watch those longer term yields. Lower yields would be great. Squeeze those shorts. I'd love to see the bond market come back, which, there's only two significant times in our lifetime, boys, that we've seen a real negative correlation of stocks and bonds. It was 2000 and 2008. If you look at like a 20-period quarterly correlation, at the largest degree, our lifetime charts, stocks and bonds trade together. So I do believe this is not the end of our entire lifetime trend of lower rates. I still think we will see lower rates. However, what is it going to do to the yield curve? That's what concerns me.
What's really interesting? You brought up a good point. And when you go back even before we were alive there, Mr. Gordon, go back to the 60s and 70s and even further back than that.
Dude, you don't have a 7 handle, though. You have an 8 handle, don't you?
I have an 8 handle, yeah.
Spencer, you definitely have an 8 handle.
Does he have a 9 handle? Are you a 9 handle?
I have a 9 handle.
Wow.
In my defense,
I'll see you later, guys.
Todd Gordon, winning the Old Man Award.
Come on. In my defense, it's one of the first 9 handles, okay?
I was the last 7 handle, so okay.
Before I forget, Todd, if you want to play golf, come down, play around. I know your wife is in Jersey, so whenever you're in that area, let me know and we'll play.
All right, perfect.
That's nor here nor there.
I
play golf now, so that's like my new thing. So
let's talk about getting over 40, man. Where you are?
This is an important point because you brought up the correlation between stocks and bonds, and as it turns out, when you go back and you smooth it out over time, it depends what the market is worried about. If the market is worried about deflation, which that's been the worry for forever, right? You tend to see that negative correlation between stocks and bonds. When the market is worried about inflation, that's when the correlation between stocks and bonds turns positive. You saw it in the 60s and 70s. You saw it more recently, right? So just wanted to kind of put some context into that because I have the data and we've seen it. It's very, very clear that there are different types of regimes of that correlation. And it really depends on what the overall market is concerned most with, which I find really, really interesting. So there's a time and a place for everything. So Todd made some good points there. Hold on. I want to get to your charts, but quickly, let me just finish the state of the markets. I think that the S&P 500 is going higher. I think this is the chart for you. We're looking at technology and healthcare. These are the two largest components of the S&P 500. Technology representing now almost 29% of the S&P. Are you guys able to see that clearly, or is it blurry?
It's not
you. It's a little blurry, yeah.
It's not you. It's Fonz. Fonz is having some internet problems, so I'm gonna show the charts from my screen as well. So cool. Just give me 1 second.
Yeah. So healthcare represents over 13% of the S&P 500. This is the second largest component in the S&P. It's actually the second largest component of the Dow Jones Industrial Average, as a matter of fact. And then you've got technology already making new all-time highs, representing almost 29% of the S&P 500. Take a look at the tech and S&P chart there, slide 2, just to put things in perspective. I think a lot of people are like, oh, technology is doing too well. Like, well, I don't know about technology doing too well. But when technology is doing well, there you go. When technology is doing well, so is the S&P, right? And when technology is not doing well, neither is the S&P. So you might not like that technology is such a big weighting. You might not like that technology is doing so well, but fortunately, the market doesn't give a damn what you like or don't like. The market's going to do what the market's going to do. And then finally, and I want to throw this over to Todd Gordon, because you and I were having a little bit of a debate on this recently, I think over the phone, talking about the U.S. dollar and the negative correlation between stocks and the dollar. And you're like, well, JC, in the 90s, the correlation, the market didn't, it's positively correlated. But it's like, yeah, well, guess what? It ain't the 90s, right? Spencer Israel is not a toddler, right? Here we are, and the negative correlation remains strong. And the only thing that the market has proven, probably since the last time you and I spoke on the phone recently, is that a negative correlation is still in place. It could change, of course. It could change today. It could change tomorrow. I doubt it. That's certainly not the bet that we're making. I continue to think that a weaker dollar continues to be a driver for equities as it has been. And if we see strength in the US dollar, it's probably coming in an environment that stocks are under pressure. So
I agree.
Generally speaking, that's my thoughts on the state of the market.
Yeah. No, I agree. Yeah. And I was thinking that dollar strength could lead to sort of a late 90s. You saw a run into the US markets in the late 90s. So people had to do a foreign exchange trade. You had to sell in foreign currency, which is local to wherever you are in the world, to buy dollars, to buy US stocks. And I was thinking that we might see that. Didn't play out. Clearly, the lower dollar now is reflecting the outlook that longer rates will drop. At some point, the market's still pricing in shorter term.
You think the dollar is pricing in rates, or is it just a lack of a defense rotation? Because there's, you're seeing consumer staples on a relative basis making new 52-week lows. You're seeing low volatility stocks on a relative basis making new 52-week lows, and the U.S. dollar making new 52-week lows. Those are the three defensive trades. Right. So is it because they're pricing in a move in interest rates? I haven't seen any data that suggests that at all. To me, it suggests that there's just no need for the safe haven that is the United States dollar.
Well, I think what's happening, it's a little tough. I mean, I used to trade for an FX hedge fund, so I used to know what was going on day by day. Right. The lower dollar certainly reflecting the lack of any additional interest rate increases from the Fed. I mean, that's what makes FX markets move, right? It's not the current.
What about foreign? What about Europe and Europe and Canada? They keep raising rates.
Well, okay, no, you're making my point. It's not the current differential between interest rates that creates capital flows between boundaries. It's the expected direction of interest rates. Europe still has an inflation problem. You just mentioned Canada still going up. So if the U.S. is viewed to be done raising rates, the rest of the world is still combating inflation, which UK and Europe. I know Europe is. I don't know where UK inflation outlooks are. The view is rates are going to go up, and that's going to create flows out of the dollar into foreign currencies, which again will further push that growth outperformance to value because of the valuation question. And this is like 4 points ago that we made is why look at fundamentals? Why look at where stocks are valued? Because based on where rates are, which the FX market is, I think, driving fixed income. Fixed income's driving equities. That becomes the valuation question. Whether you want to be in growth or value is based on the outlook of where rates are.
Agreed,
do you want to hold higher valued stocks, undervalued stocks with staples based on where rates are going? So it's also connected. It's so awesome when I think all major asset classes are trading together. It makes the investment picture so fun because sometimes they can just drop off. FX is done. Rates are not moving. It's just all about like stocks and commodities. Right now, we're moving into a macro situation where all four asset classes, equity, fixed income, currencies, and commodities are all playing together. So it's cool. It's fun right now.
We call that intermarket analysis there, Mr. Gordon.
Yes, sir, we do.
And it's really, like we said earlier, even if you don't trade bonds, there's so much good information there to help you make decisions in the stock market. Even if you don't trade Forex. I don't trade Forex. Have I ever traded Forex? I've probably put on a few futures trades, but I don't trade Forex per se. But guess what? Every morning when I wake up, what's the first thing I look at? I look to see what the foreign exchange markets are doing, right? And I don't even trade Forex. I look to see what the bond market's doing. I don't even trade bonds, right? I'll trade some commodities and stuff like that because there's commodity related, and I'll trade like commodity ETFs and stuff like that too. So of any of the non-stock asset classes, probably commodities are where I trade. So that's the first, but I'm not even focused on those areas. And just to put things in perspective, those are the first markets I look at in the morning is commodities, Forex, right, and interest rates.
And that's a dark, deep hole that we don't want to go down. I mean, that's one of the reasons I left FX is I was tweeting with, I don't know, I think it was Tom Lee. I was tweeting with somebody yesterday, and they're like, I was like, that's why I left FX, because I got so sick of the coming dollar demise stories that are so misfounded and just so no clue what's going on and how.
By the way, there's a coming stock market demise story out there too. I don't know if you heard, and bond market demise, and like everything's always falling apart.
It's so annoying, but China's going to get rid of the U.S. Kind of pegged to our currency. Great, you're going to let your currency float. It's going to be revalued so quickly. It's going to crush your export markets, whatever.
No,
Don't
Todd,
get caught
it's
up in that crap.
The Iraqi dinar. That's the one that's going to be the global currency of choice. I
Yeah,
don't know if you heard that one.
Great.
That's been a conspiracy theory for 20 something years. The Iraqi dinar.
It's, but bringing it back though, and you tell me where you guys want to go in this conversation, but, I think the intermarket analysis lessons that you and I grew up studying, I think John Murphy did an amazing job laying them out. I think there's a lot of parallels what's on a shorter, more compressed time frame from what happened in the 70s, like stagflationary 70s, inflation through the roof. And then what happened is commodities peaked out in the 80s, rates started dropping, yields started dropping, and inflation was moving up at a rate of change that was consecutively less, which is called disinflation. And the disinflationary period of the 80s created one of the best stock market runs that are, the last 3-4 generations.
Isn't this what this has been? Haven't we been in this? I'm no economist, but isn't this what this is?
That's my point. I mean, I can show you some CPI charts, and Powell was taken in the teeth for using the term transitory with inflation. But you look at a chart, a CPI. It'd take me a minute to pull it up, dude. It's come off as fast as it went up. He was right. Inflation's coming up,
but it doesn't feel transitory in the moment, Todd.
It doesn't. But
try explaining to someone. 1 year is not a long time.
And by the way, for the record, those of you who are focused on lagging indicators like things like CPI, the bond market's already been pricing in the top of inflation last spring, over a year ago. So now you're seeing all these CPI data is completely collapsing. It's oh my God, inflation's coming down. It's bro, the bond market's been telling you this for over a year.
Can I pop up the screen?
Oh yeah, go for it. What do we got here?
So this is just CPI year over year change, right? So the right chart is CPI. This is from the Fred database. This was before the June print came in, which came in at 2.97. Right. So this is the actual consumer price index on the left. And then this is the year over year change. So the scales are small over here. Sorry. But 18, 20 right there. So here was the CPI spike post pandemic. But look how fast it's come off. And then the new print, I could pull up new Optima charts. The new print is right here. I mean, that's a pretty vicious up and down quick round trip. I mean, you're looking at the data, and a lot of people, conspiracy theorists, would say, can't even believe the numbers the governments are giving us. They're understated. But these are the numbers that are in front of us. It's come up pretty quick and come off pretty quick.
I got a chart for you.
And yeah, that all may be true, but again, in the moment, it doesn't feel. Just try telling someone that it's temporary, right? In the moment, right? It's hard.
Nobody cares about the market. Doesn't care about people's feelings.
So you're totally right. You're totally right.
If you're making decisions based on your feelings, you've already lost, and we're gonna take your money. Right?
I don't know. It worked out for me. I felt Barbie was going to be a good movie, so I bought Mattel. That worked out.
Stop. I can't even with you. Hold on. Throw up slide 1 to Todd Gordon's point, just to back up that here what we're looking at. This is very simple. You don't need to look at fancy spreads. You don't need to have a Bloomberg terminal. You could just very simply take the inflation protected treasury securities.
I was just pulling up basically the same chart
and compare them to nominal yielding regular treasuries. And what do you know? Bond markets inflation expectations peaked in April of last year. It is now July of the following year. So if you are surprised at all in any way ever that inflation numbers are down, you're crazy. You're looking at the market with a blindfold on. Don't. And this gets back to our earlier point. Todd and I rarely trade bonds. We'll throw on the occasional TLT chart, but this is a bond chart that's telling you what the bond market's pricing in for inflation. Yeah. I'm not going to trade. I'm not going to buy tips. I'm never going to buy tips. I mean, maybe one day. But
actually, I do hold tips in our fixed income portfolio, but that's okay.
Right, but you have a fixed income portfolio. That's a different story.
Obviously. Right.
Yeah, that's different.
And this is cool. If you look at, here's 2-year inflation expectations versus nominal. It's a small chart, but there's a huge divergence happening right now. And this is going to be interesting. And I know you don't like to watch what's going on with the Fed and the commentary coming out, but they're going to have to address this soon. And it plays into positioning, it plays in expectations. And will this growth trade continue to rally here in Q2? So this is 2-year nominal treasury yields in blue, and black is the 2-year expected inflation. And this is coming out of this is the Cleveland Fed. Also, I've got data from Cleveland.
I didn't know Cleveland had a Fed.
They do.
I thought they were the Guardians now.
Yeah.
No, they're the Football Hall of Fame, right?
Which is super sick, by the way.
Canton is football. Cleveland is the Rock and Roll Hall of Fame.
By the way, the Rock and Roll Hall of Fame, underrated. Underrated.
Oh, JC, I took the Twins to Cooperstown 2 weeks ago for the first time.
Oh, man.
I went as a kid. It was like Disneyland for me, and it was just as awesome as I remember it. You
love baseball. Like, if baseball's like a thing, and I'm Cuban from Miami, so it's a thing
I know.
me, of course.
Dude,
if you're into baseball, it's a cool town.
Oh my God.
Hate baseball, don't go there.
Oh my God. We had the Twins they were in a tournament last night. We went to extra innings and they lost 12-11 in the 8th, and they only go 6. It was I've lost my voice. But anyways, back to this point. At some point, they're going to have to reconcile the difference between this. Can I share that one more time? So again, 2-year yield, we're up around 4.8, 4.7 on the left scale, and then 2-year expected inflation is down to 1.53. Here's the problem. The expected inflation 2 years out is 1.53%. The 10-year, I could pull that up quickly too. There's a huge, huge divergence between nominal yields, where the 2-year yield is, and expected inflation. At some point, Powell is going to have to stop clubbing us over the head with hawkish talk, higher for longer. We're dead set on our 2% inflation mandate because markets are really pushing. I mean, you said it earlier that they're pushing the Fed's hand. They're calling them out. We still have rate cuts on the table for next year, but I am concerned that if they blindly continue to hammer this narrative, do you think they're going to be able to just stop that rated change in inflation on a dime? You're talking about the U.S. economy and by extension, global economy. The rated change for inflation is so strong right now, and Powell is so resolute pounding us with this. Is he going to be able to stop it once we get to 2%? There was a last chart I showed you. We had several oops on the way down. We keep dropping through. It wasn't 5 years ago. We're looking at negative real rates. So at some point, he's going to have to take a more calm approach in terms of expectations of inflation. He'll never say I'm done raising rates, because if that happens, the freaking tech market will rip on the upside. But he's going to have to be more soft, and that is another reason, I think, to continue to favor the upside in growth. Again, I'm not trading based on the fundamentals, but I'm looking at the charts and what markets are pushing the Fed. I think there's a spectacular rally coming up, and I'm not a long only money manager like you. I mean, I'm running money as well. I could be in cash in an hour.
I'm not long only.
No, I know, like you. I know you're not.
But like me, you're not. Right.
I'm not. I run money.
Like, I'd rather be short, to be honest. Are you kidding me? The best thing that can happen to us and our families, considering how young we are, is for a 90% crash, Great Depression. That would be the best thing ever.
That would be good.
I can't bet on what I want to happen. I have to bet on what is happening.
Right. I mean, it's easier trading in high volatility markets. I was day trading right out of college. I mean, 2003, 4, 5, and 6. I mean, there was no ranges. Active trading sucks when ranges are low. Just buy and hold. So again, I'm very bullish, and the Fed has kind of backed themselves into a corner. I think further losing credibility that they keep saying higher for longer, and the market just keeps pushing them. And when they have to finally relent is, I think, another trigger to add to the growth trade.
Before we move on, I want to get to this question from the chat before we get too far away. It's about sector rotation. How do you guys observe or measure sector rotation? Do you just run relative charts with the S&P against every sector and see it that way, or how do you observe it?
I love Julius de Kempener's relative rotations. I watch them. They've become a key part of my arsenal. RRGs are great. If you're asking me, I just took that question. I don't know if that was for me or not.
No, it was for both of you. Yeah.
Yeah. Let me just make sure. Yes.
You
So
know, I think I
go ahead,
like
JC.
I like just going chart by chart, looking through a few thousand charts every week. And you could really see that sector rotation. You could really see the internals of the market. I think a lot of investors where they get mistaken and they get things wrong, where like last summer, for example, people thought we were still in a bear market because they were leaning too hard on the S&P 500 or the NASDAQ instead of just taking the time and counting how many stocks are going up and how many stocks are going down. Literally, there were barely any stocks still going down at the end of the second quarter of last year. So if you just took the time to go and count for yourself instead of waiting for your stupid computer to tell you, right, you would have known that it was time to be buying stocks. But which stocks? It wasn't technology. It wasn't the growth stocks. It was industrials. It was materials. It was financials. Those were the stocks that were already working. The stocks that were not working were the growth stocks. So in the back half of last year, everything was working. It was so easy to make money, except in growth. So what we came into the year looking for is rotation, right? So if you're going stock by stock, you're like, these things are still not working. Tesla, Carvana, all these beat up growth stocks still are not working. And then what happened this year? We got that sector rotation, and the worst performers in the back half of last year have been the best performers this year. We call that sector rotation. And then a couple of months ago, it's like, well, the initial leaders off the lows last summer have really been underperforming so far this year as growth took that leadership. We need to see some of that rotation. And again, you can see it when you go chart by chart. Small caps, industrials, some of these other areas that were just not working as well or at all. And now those are the best performers over the last couple of months. So when we talk about sector rotation, it's the lifeblood of a bull market. It's necessary. In bull markets, the laggards catch up to the leaders. And in bear markets, it's those remaining leaders that ultimately catch down to the laggards. So in bear markets and bull markets, there's sector rotation. The question is, in which direction?
Yeah. Yeah. And, I think it's further giving us, I think, conviction looking at the rotation, what's happening. And again, if you constantly are consuming the headlines, all you read about is the Magnificent Seven leading this rally, which that the rally has broadened. And this is if I could share screen, I'll kind of bring it to you to show you the broadening.
In fact, those seven stocks are actually massive underperformers. There's so many other stocks doing better than those.
I mean, there's a few. I mean, listen, NVIDIA continues to go. Apple continues to go.
3 of them are in the top 20 this year. So
right. So just looking at sector rotation. So this is your sectors year to date. I mean, it's just massive looking at just percent return. So XLK, XLC, XLY, those are your three growth, 44, 40, and 36. And then there's the SPY, and then there's everything else. So what we did is we kind of broke up the value sectors: industrials, materials, real estate, financials, blah, blah, blah. But the line in the sand between these is pretty crazy. So looking at the value, this is the left chart. I know it's small. The left is the monthly rotation. So you're benchmarking these three guys, staples, health, and utilities, to the S&P. Each one of those small dots is 1 month. Over here on the weekly is same deal. So healthcare, utilities, and staples are heading in a southwest direction, which means they're losing momentum and relative strength to the benchmark S&P. If you're looking for value, you want to wait to see a little bit of a turn. These guys are the dogs of value, okay? But there is some rotation happening within value that is broadening out this rally. So you're not getting much on the monthly. Everything is heading down to the left. Energy is coming off of its massive outperformance, but you're getting some of these value guys starting to make a move up. Industrials have been great. And if you break down into the sub-industry groups of industrials, some really good names in there. Yeah. Financials have been coming on, materials, even real estate, and then energy. So you're actually getting a broadening. And what's cool about what's happening here is it's not the large cap, it's the small and mid caps that are rallying quite sharply in here. So you're definitely getting a broadening from value along with tech. And then this is just a simple chart. This is your growth sectors: comms, tech, consumer discretionary. These guys are continuing to move up in the right. Tech looks great. Comms kind of struggling here in the weekly. Google's kind of losing it. And then you got these weird telecoms and communications, which I think kind of muddies it. But tech looks great. Consumer discretionary looks great. Growth is on. We're getting a broadening of the market capitalizations that are rallying. So when people, and I think there's a few people still saying this market's only being led by a few, it's just wrong. It's completely wrong. We're getting a very good broadening of the rally.
Just think about how bad at math you need to be to think that it's only 7 stocks. Like you have to be you have to be criminally insane, I think.
Or you just want to attach yourself to a narrative to make it sound like you know what you're talking about.
You got to be a special kind of loser to think it's 7 stocks.
But by the way, Julius de Kempener is the guy that came up with relative rotation. We're going to get one of the guys. We're going to get one of the guys that works with him on this show. One of these weeks.
Why don't we just get Julius?
Julius is a dear friend of mine. I mean, I could call him right now and bring him on if you want.
Dude, when we should go to Amsterdam, all of us, and go party with Julius.
All right.
You know, because we're gonna go there. We're gonna go there in the spring, and then we're gonna go. We know we have access to the books from the Tulip Bubble, like the actual book where they were writing down the prices and stuff. Like we're gonna go look through that book. So if you want to come join us.
Yeah, I'd love to.
We'll go to some of the coffee shops. I hear the coffee's great there.
All right.
Oh boy.
Oh man, next spring is around the corner, JC.
This is a family show, JC.
Hey, listen. It's 9:07. We're gonna bring on Kimmy Sokoloff in about 8 minutes. So let's real fast do at least a couple of earnings if we can. We got a lot of movement overnight here. And
just throw him a bone, Todd. Throw the kid a bone.
A lot of movement. Look, it's not me. It's the market.
Listen, I came in with a lot of options with Tesla, and I was kind of thinking it'd be 320 bid on the open, not going so well.
No, it's not. So one thing that does annoy me with earnings is there seems to be this a consensus is made somewhere on like what we're supposed to care about each quarter, right? Like sometimes it's this metric, other times it's that metric. Apparently, the consensus was we're supposed to care about margins, gross margins.
It's all about margins, yeah.
Yeah, maybe that's what happens when you get to be a mature company.
I'm sorry to interrupt. And they say technicals are subjective. Give me a break.
Humans are dumb.
Right. Okay. So anyway, the bottom line is on Tesla. If we have the chart here, which I think we do. Let's bring it up. So there's the chart. I don't know if you guys can see that. I'll bring it up on my screen real fast. Anyway, the earnings beat, the revenue beat, but again, it's some of the margins. I guess they're going to do a factory update here, so that's going to hurt their delivery numbers. But margins did fall. Margins fell 11 percentage points year over year. That was mostly due to price cuts. The average Tesla vehicle sold for about $45,000 last quarter. That was down from the first quarter, and it was also down from $56,000 year over year. So I guess we're supposed to care about margins now. But anyway, that's the hullabaloo about Tesla, and that's why the stock is reacting the way it is, because the margins were lower.
Yep.
Yeah, I mean, just from a tactical perspective, that 300 is a big level. Throw that chart up one more time, the one that you just had on. That 300 level is a big one for me. We talked about initiating short positions if Tesla's below that. It currently is. Now, granted, it's substantially below that in the pre-market, but if Tesla's below 300, there's just no reason to be long at all. That's a big level. This level goes back a long ways.
I'll take the other side of that trade, JC.
You're buying this dip right here, right now?
I mean, I'm long, and I've been long. We had the stock from 170 with research, and I just own it in the wealth management and had options coming in. There's a huge, massive downtrend line from the all-time highs. We're at the 786 retracement. It's a good Elliott wave pattern. It's in the middle of wave 3. Okay, so margins came off. EV credits and tax credits were a big part of it. They're cutting prices to be more competitive. I think we blast through 300.
If we do, I'll buy it. I think that's the trade. I think if and when we get through 300, you buy it. Yeah. In the meantime, I don't think there's anything to do.
That's fine. Yeah.
I think we're saying the same thing, different time.
Yeah. No, I agree.
I wish we didn't agree. It's better when we disagree.
I mean, when you have a good entry price, right, that gives you options, and that's important. As a trader, as an investor, the best thing to do is make sure you have good entry prices, because that gives you options and that gives you optionality at such key levels. I agree. There's so much at this 300 level downtrend line. I think is the August 22 high, 786 retracement. It's an 100% projection off the lows. I mean, this is a monster level here at Tesla.
Yeah. Not to mention the psychological level of 300 and like all those things. Like there's just so much here, from a tactical perspective. For me, it's not worth, it's not, again, you have a different time horizon. You're already in it, all these things. Like there's nothing wrong with that. I'm just not in that situation. I don't have a position in Tesla. I'm looking to put one on. If I had to, I'd be short. And if we break out 300, it's a buy. It's that simple.
All right. Netflix here. This is the first report since Netflix started their account sharing crackdown thing. EPS beat, sales missed. Subscribers came in with a nice beat. I guess that's what happened. I guess we knew that was going to happen. They did say about a month ago that they had added a shit ton of accounts because people had lost sharing access from their families. So paid subscribers up 8% year over year. Remember, it wasn't that long ago. I think it was last summer that their subscribers actually fell for the first time.
Yep.
It was last summer. So anyway, 8% year over year subscriber growth, which you want to see obviously for them. They guided some numbers going forward that came in above estimates. So it was all in all, it was a good report for Netflix. What's the stock doing right now? Stock is down. Yeah. Well,
take a look at slide 1. I still like Netflix from the short side. Again, 460 is the big level there. It's as clean as it gets. There was a ton of former support. That's like a brick wall. The market's obviously acting accordingly. If we're below 460, I definitely do not want to be long. Quite the opposite. I prefer it from the short side or some kind of neutral position. What do we talk about? Maybe selling calls, naked calls, something like that. Nothing to really do here from the long side if we're below 460. Kind of like Tesla at 300. If we're above that, a long position is going to make a lot more sense to me. Below that, stuck below overhead supply is no way to go through life.
No way to go through life. All right. Big loser of the day here is Discover Financial. They had earnings, but the earnings is not what matters. What matters is that they said in the release and on the call that they're going to temporarily halt their buyback program. We all know how much Wall Street loves its buybacks. They're going to halt their buyback program while they investigate some misaccounting of credit accounts from 2007, or misclassification of certain
old ghosts coming back there, Todd.
Yeah,
boy, that skeleton's in the closet.
Yeah, right. Yeah. So anyway, they said they incorrectly classified certain credit card accounts into the highest merchant and merchant acquirer pricing tiers. Again, 16 years ago. So anyway, while that's going on, they halted their buybacks, and that's why the stock is down today because of that. So,
how much is it down here pre-market?
I just looked. What is it?
It's down 15%. Well, yeah. Okay. Listen, take a look at my chart here. I like, whenever in doubt, we like to zoom out. Right? I think that's a Brian Shannon quote. Is that a Brian Shannon quote? I think it is. And this is what I'm seeing here, bigger picture. So we're down here in the pre-market right around 105.
I like that.
Listen, I don't hate buying this dip, depending on your time horizon. If you have a longer term time horizon, Todd, any thoughts here on maybe buying the dip if it could stick that at 90 level? I mean, you got some room. It's still in that range, but it's not terrible.
It's interesting. The last 2 weeks we've been doing a deep dive within financials, as I mentioned, financials rotating in, and consumer finance, which Discover is part of. That industry group has been showing a lot of relative strength, leading the financials up. Capital One, Discover have been on our radar for a while. That's interesting. Coming back from 2007, I got to read that story a little bit, but I actually wouldn't mind looking at Discover, Capital One. I actually have another name in consumer finance. I'll shout it out here when you guys are on the next topic.
Ooh, interesting. Okay. Well,
hang on. Who's the better skier, Todd Gordon or Brian Shannon?
Are you really asking me?
I think both of you are excellent and way better than I am. So, I was like, I was a racer.
Quick question. Quick question before we bring on Kimmy. This winter is going to be the winter when I actually take my wife skiing. She's never skied before in her life. You have any advice?
Advice, what to keep her upright or where to go?
Yeah, or like for the day to not end in like divorce.
Don't drink until after you're done.
Okay, so here's what you do.
Yeah.
You go, where are you thinking about going?
Just a local spot, Mountain Creek in Jersey. Just
Mountain Creek.
Yeah.
All right. If you want a surefire thing, what you do is you like go to like Park City or Breckenridge. You go to the ski school and you're like, give me the best looking 25-year-old like Swiss dude with a perfect accent. Book a 3-hour lesson with her. You're golden.
And then I don't do anything is the point.
Exactly.
Right?
Go to the bar.
All right. Yeah, I go to the bar. All right. That's what we're going to do. All right. Kimmy Sokoloff joins the show every day at this time to tell us what she's trading. Let's find out.
What's up, guys?
Kimmy, do you know Todd Gordon? You guys know each other from Breck, right?
We briefly said hello. Hey, Kimmy, how are you?
Good, how are you?
Good, thanks.
I think we met once.
Before Spencer joined the team here, we had a nice little extravaganza out in Breckenridge, Colorado, Chart Summit 2019. Kimmy Sokoloff, Todd Gordon stole the show.
That was such a fun event.
Was that 2019?
That was 2019. That was before COVID, remember?
Wow.
Yeah, I know it was before COVID, but yeah. They all went skiing. I don't ski.
Oh, yeah.
So, you're a big skier, Todd?
Yeah, that was my sport growing up. That was my sport.
I guess you could say that, right?
My dad brought me skiing once when I think I was like 12, and he saw I had no fear, and I just, listen, you go upstate New York to like the Concord, they're like little bunny slopes. It's not like real skiing. And so, but at the end of the day, I went down the biggest mountain for there, which is small.
Wait, hold on.
I just flew down it and like 2 times. And the third time I went down and, face planted. And he goes, we're not doing that again.
Oh, wait, where in upstate was this?
It was like called the Concord, upstate New York, the Concord Hotel.
Okay.
Tiny little. I mean, they're not like big. They're tiny.
Yeah.
It's not like being in Colorado.
I'm in upstate New York now. I'm in Saratoga Springs, New York, which is about 3 hours north of the city. But yeah, cool. That's awesome. Hey, unless you live in Florida or North Carolina, South Carolina, or California, you got to do something during the winter. And rather than sit around and complain about it, you might as well get out and do something athletic.
Yeah, well, I went snowmobiling. I like snowmobiling.
I remember people that didn't ski in Breckenridge went snowmobiling. Hold on. Can we talk about something? Can we talk about something important? Because Kimmy, you're on another level. What was it yesterday? 5 for 6 yesterday. Long Moderna for a profit. Shorted United Healthcare, profit. Bought Carvana, profit. Shorted Spotify, profit. Bought Meta for a profit. One loser in Valero, 5 for 6. Absolutely crushing it. What do you so far for the week? Like 20 or 22 or something crazy?
Well, Valero actually went to Target, so that's my bad. So I stopped myself out. Yesterday was a terrible trading day. I know I did well.
Yeah, sounds terrible.
No, because I made 2 mistakes. While I was watching Carvana, I bought CrowdStrike thinking I was up almost a buck in it, and it pulled all the way back in, and I stayed with it. I'm trying to see how it holds. I was looking for 162 to hit a new high, pulled back in on me, and I was watching Carvana, got in late at Carvana. I was looking at Carvana at 51.80, and it spiked. I was looking 51.80 up to 55. I missed that. Carvana's crowd's going. It was terrible. So no. I stayed in crowd because I like the name, and I'm down like 4 or 5 points in it. I'm going to watch it. Also, I bought PDD. It completely reversed, but I like the pattern. I'm going to stay with it, see how it goes. So, I made, you could call it 2 mistakes in there that are not great. Other people, you have to stop out. Valero wound up going. I didn't stay with it. I think, whatever. I don't think it was a great day. It was a bad day.
Let me ask something quick. I started in San Diego, first job out of college. I was prop trading, and we're trading listed, listening to the floor of Chicago Merc.
Wow.
How often are you following the direction of the indexes in order to guide your trades? Or are you trading mostly uncorrelated stocks? Like Carvana is not following the S&P. I mean, do you use the indexes sort of your
I
guide?
have them right on top. Everyone gets to see my screen, so they're right there. The SPYs, the Qs. I always have them there, see how they're doing. I always keep eyeballed. And we had two yesterday, two drops intraday, right? So
that was my point. It was a choppy day because everyone's getting ready for a lot of.
I think people were taking profits before, let's say, Netflix or
100%. It seemed like a very goofy intraday trading market. And that's the reason I'm asking.
Now, I've been short Netflix for a while. Okay. So, but I can't, I tell people in the room, shorting is not for most. I will stay with a short and press it and trade it throughout. Okay. I might be down on my original shares, but I'm up overall because I've traded it throughout. So sometimes I handle trades as like a portfolio manager because I worked with PMs for most of my career. So, and I say, listen, people are new in the room, I press shorts, then I cover. I press and short. Yesterday after hours, I put a short on Netflix. I don't tell the room that. That's not appropriate. It's not appropriate. If I was dealing with a PM, that's very different, right? So I added it on. I covered more this morning. I make, 30, 40 points or whatever it may be. And I'm really up in my trade, but I'm still in my original shares. I could cover my original shares and be up in the trade. So I can't tell people, if the trade's not working right at that moment, stop out, because I might stay with something because I think ultimately Netflix could go down to 380, at some point.
Yep. Gotcha.
So Kimmy, I know you got to leave to go trade, but quickly, this Target, I like where your head is at with this one. This one has gotten beat up. A big conversation that we had before you came on has been sector rotation and all that rotation that we've been getting. And money has been rotating out of Target for quite some time now. You're thinking there's a possibility that rotation that we've already seen a little bit into it continues?
Well, if you look at the chart, look at it. It's stuck. It's really stuck under 135 to 138. I'm also looking at Nike. We traded Nike early in the week. We did well. But it's really, I think Nike maybe has potential up to 112, right? So these names are stuck, and Target has been stuck. We have traded Target. We traded for 70 cents, $1. It really can't get out of its own way, which is understandable. But, I'm trying to see if it, hey, if I could capture, $1 move in it, $1.50 move, right? So we got to see where it's going and all that stuff.
I like where your head's at there, Kimmy. I like where your head's at a lot.
Thank you.
All right, guys, if you want to join Kimmy's room, she's there. That's where she's going right now. She's there every single day through the open. You can click the link in the description, click the link in the chat, or scan the QR code on the screen. Those are the only ways to get in, as far as I know. So, Kimmy, have a good day.
Dude,
all right.
I love the fact that I love the fact that her one loss, Valero, wasn't even a loser. Jason Wolcott in there saying she was right on that one too. She just stopped herself out, being a little too defensive there, which is, I've never seen anything like it. I've never seen anything like it.
Yeah, she's good.
She's
real good. All right. Also, her morning and her afternoon note, that is free for now, at least. If you want to get those, email us questions at stockmarketmedia.com. We'll get you on the list. Back to the earnings for a second. I also love sometimes the dichotomy between what the companies are saying, what the market is doing. So the airlines, for example, right? Last week, Delta Airlines came out and said business is amazing. Okay. Overnight here, you had American and you had United. Same thing. Business is amazing. Beating on earnings, raising guidance. Okay. Awesome quarters. They're saying people are flying, we're spending money, we're raising our guidance for the year. And what is the market doing? Well, these stocks have been on huge runs, right? So stocks aren't reacting the way you might think. So stocks are all down here. Delta is still down from its report. United and American, they're both, I guess United is up this morning. American is down this morning. But they were objectively good reports. They raised their guidance, for crying out loud. Anyway, let's bring the chart up here. Do we have one of them? Which one is this? This is American. But Todd, what do you think about that?
I within the industrials, airlines are doing extremely well, rotating in, extended. And I'm listening to the fundamental crowd say, the consumer stretched, their capacity for selling additional seats is max unless they're going to order new planes, which is a 2-year cycle. I just don't believe it. We're seeing really good movement in consumer discretionary within travel related industries. I love the technical patterns. I have a feeling that when there's demand, the market will find a way to meet supply. I don't know if business travel comes back. I'm just trying to figure out a way to justify additional upside. I love the pullback Delta. If I could get a look at Delta around 44.5 to 45, I have that on my radar right now. I'd love to buy this pullback. Looks like we're trading 47.90 pre-market. But again, I just, if we could see a 53, 54 bid in Delta in the next couple weeks, I'd love to see how they explain that, the fundamental crowd explain it. Technically, I think looks good, and it's a trade that I want to put on.
JC, do you have any thoughts on the airlines or not really?
Yeah, throw up slide 1 there. Airlines making new 52-week highs. Technically they're considered industrials. To Todd's point earlier, when you break down industrials into individual industry groups, there's a lot of different areas that are working. Industrials is a very diversified
really
sector.
is.
No
It
stock
really is.
represents more than 4% of the entire sector, which is really interesting. Airlines are technically industrials. You could consider them kind of like close cousins to consumer discretionary. At least I do. And and consumer discretionaries have been the best performing sector on an equally weighted basis this entire bull market, not tech. Tech's actually the third best performer. The best performer has been discretionaries, then industrials, then technology. So this, you're getting sort of industrials and consumer discretionary sort of, right?
Within the industrials, like the passenger airlines, we're seeing really good rotation within there. So the names, I think I mentioned them. SkyWest is the NVIDIA of the airlines. Like it's everywhere. Delta, United, and then Alaska. ALK, I'm liking that from the fundamental point of view and the technicals. And then just within the industrials as well, related to the housing boom, building products group, there's some really good names in there. AAON, Carrier, CARR, Fortune Brands. There's a lot of industrials that are benefiting from this huge move in housing. Similar story with housing stocks with those airlines. It's like, how is there more ability for them to continue to grow and extend that upside? We're in a huge housing move right now. We have visibility on rates. And again, I'm listening to the fundamentals say there's no way that housing stocks can continue, but looking at related secondary sub-industry groups, there's a lot of indications say it continues to go. So I like housing, and I like the building products group within industrials.
All right. I want to move on here. I want to talk about Taiwan Semi. This is an interesting one. Okay. This was not a good report. And, of course, Taiwan Semi is the actual maker of semiconductors. And they said that even though chip demand for AI is strong, it is not strong enough to offset broader demand weakness for chips. So they actually came in with their first year-over-year decline in revenue in 4 years. And they guided lower as well. Their guidance was lower by about $1 billion below expectations. So
is that all?
Well, yeah, 16 versus 17, right?
Why don't you take a look at slide 1 there to kind of really put things in perspective? A lot of investors think that the reason the stock is down is because of earnings or a lack thereof or revenues, when you could clearly see it was just former support turning into resistance. It's clear as day.
Well, my point was, though, it's more about the comments from the CEO, right? That AI demand is strong, but not strong enough to offset broader weakness everywhere else.
I think it was because Strazza and Sean. So listen to this, Todd. So I don't know if you know what's going on, but one of the reasons that you're invited to co-host, and by the way, you have an open invite. You can co-host even when Strazza gets back, for the record, right? Friend of the show, friend of ours. You're not just a friend of mine, you're a friend of ours, right? And Strazza, Sean, Giancarlo, the whole crew, they're in Manila and they're having a great time. They're having so much fun. Like they're in Manila and they're eating. They're having like 3 lunches, 3 dinners. Like these guys are out of control. And they're calling me.
What was their per diem, JC?
Don't even go there.
We gave them cash up front.
Don't even
forget
go
what
there,
it was
Todd.
divided. Some countries are more like in Vietnam, like everything's free. And then Tokyo, it's the opposite, right? So it just depends on the country that they're in. So anyway, they're in Manila and they're like, JC, we really don't want to leave. We want to stay. Let's just skip Taiwan altogether and go straight to Hong Kong. Forget Taiwan. And I'm like, but Taiwan's got great dumplings. And then, we have a meeting at Bloomberg and like we got to do. And they're like, JC, come on, man. And then I'm like, you know what?
It's just
the hell with it.
historic.
Just skip Taiwan, stay in Manila, have fun. And, because they were going to go to the Philippine Stock Exchange the next day, and they wouldn't have had time if they went to Taiwan. I was like, fine, skip Taiwan, get to Hong Kong earlier. And the ovation that we got when they walked back into that dinner to tell everybody that they weren't leaving, because now they have so many friends in Manila, apparently, that it was kind of like standing ovation. Everyone's going bananas, like it's New Year's Eve all of a sudden, because they're not leaving to Taiwan. So they skipped Taiwan altogether, and now the boys are in Hong Kong.
I don't know. I would say it would be kind of historic. I mean, what's going on with China? I would kind of want to see that. I'd want to be there.
Well, when they go back, they have a lot of
Yeah.
they have a lot of invites now. They were at Jim Rogers' house a couple of weeks ago in Singapore, and I think Jim Rogers is now so on board. I think he wants to take them to mainland China and do Shanghai, Shenzhen, Beijing, and then when they do that trip, just mix in Taiwan in that trip is sort of where my head is at.
I'll never forget. I was giving a speech in Shenzhen. I think it was north of Beijing. I did a tour. It was their equivalent. It was Moon Day, their equivalent of Thanksgiving, and they were there listening. I did like a 4-hour speech till 7 p.m. I was like, guys, thank you, but go home. It's your equivalent of Thanksgiving. Like, go home to your family, please. Like, go. It was awesome.
I love it. You want to show, for those of you who don't know, we're shooting a docu-series out in Asia where our best traders are interviewing the best traders in each of these cities, hence why they were at Jim Rogers' house in Singapore, and many other traders as well. Wall Street to all streets. It's actually very exciting. If you want early access to in-person screenings, which we're definitely going to do, make sure to click the QR code. How am I doing here, Spencer? How am I doing?
You're great. Good. Yeah, click on the QR
code. Click on the QR code so you get early access. We're not going to put the trailer today. We play it almost every day. So go check out the trailer on wallstreetallstreets.com.
Yeah, there's also a link in the top of the chat and description. So check it out there. It's gonna be fun.
These guys are eating. So I'm getting pictures from them eating sushi last night in Kowloon, like overlooking all of downtown Hong Kong, dude. Oh, I love Hong Kong, man.
Just follow on Kimmy real fast. She did end up buying Target for a quick trade. So she's in Target.
She's not dumb.
Anyway,
I was short Target. I had an option butterfly on around 135. I caught the first push down. I feel like this consolidation ultimately gives way to another push lower. It should have got back above 135 and it didn't. I might try to, for this is a longer term. This is a month or two trade, do a downside put spread on Target. I feel like it wants to still reach lower.
Interesting. Target considered a consumer staple, not consumer discretionary. Fun fact.
That depends on the household, I think.
Oh, it depends on the S&P, the index providers.
I think in some households it is a staple, and in others it's a discretionary.
Yeah.
My wife hates it. She says the place is terrible.
My wife said the same thing. They said she used to love it, and it's gone to crap.
I think your wife and my wife would get along really well. You're always telling me that.
I think so. Oh yeah, is she?
We'll get them together. We'll go play golf and we'll stick them together.
Is she beautiful but challenging?
That's about accurate. That's about
Todd, blink twice.
What is the safe word?
All right.
Should we do a little chart report? What do you think?
No, let's do hot corner first. We actually had something today in hot corner. Interesting. So well, we do most days. So let's bring that up right now.
Hot corner. So hot right now.
I saw a what was it, Lockheed? Is that what I saw?
Yeah, Lockheed.
Yeah. We had it. Oh no. Why is our Chart Ninja's internet is not working today? Let me get it up on my screen here. I don't know why we're having problems with Fonz's chart today. But yeah, we had a buy from Lockheed Martin. It was a director, $250,000. Where's my chart? Get up on the screen.
That's an industrial group. I'm watching defense, man. They can't get out of their own way right now. None of them look good. General Dynamics, Northrop, Lockheed, Raytheon. I'm waiting for them to go, and they're doing nothing.
Well, just look at the ITA in general. Just stuck below that overhead supply. We've been talking about it. That's the Aerospace and Defense Index Fund, ITA. Yep. Here, I'm going to throw it up on slide one. Throw this one up there, which is to Todd's point. They can't get out of their own way. It's bigger than just General Dynamics. It's bigger than just Northrop Grumman. It's the whole sector. And when we talk about industrials and how many different industry groups are in industrials, this is one of them, and they're just not going. Throw up slide 1 there, Spencer.
Yeah, I'm working on it.
Even Boeing looks like it wants to go, but that guy can't go. I mean, relating back to the passenger airlines, I mean, we've got to start seeing some orders come through. You know, the airlines are getting reducing debt, technically looking good. Got to increase capacity. There's got to be some more airline or some plane orders coming through.
I guess I'm just still waiting for this breakout. I've been waiting for this breakout for a long time. Like, this chart is a staple in my routine, and it's just like, man, this thing just doesn't want to go. But I think what you'll agree with me, Todd, correct me if I'm wrong, is that when it does go, it's gonna go. No,
it's gonna explode.
Real fast. That was good. That was
terrible.
So Lockheed Martin, and then on the unusual option side, Melco.
Stratasys also.
Stratasys?
Yeah.
Oh, you mean in that group?
Am I looking at the wrong? Sorry. Am I?
That was yesterday, man.
Oh, sorry. I apologize. You're right. I'm like, man, more unusual activity again,
dude. Yeah, remember we had the whole thing about 3D systems.
Yes.
Yeah, okay.
JetBlue unusual buying.
Yes, JetBlue. Melco jumps out to me. I haven't looked at that stock for a hot second. Wrap Technologies. Oh boy.
All right, what's your beef with Wrap Technologies?
The chart is my beef with Wrap Technologies. At least last time I looked at it.
I don't think I've ever heard of Wrap Technologies.
Yeah, it's small. It's below your line, JC. That's why you haven't heard of it.
Is it below my line?
All right. It's below your line. Anyway, guys, the hot corner is a free daily note highlighting all the biggest trades from Washington to Wall Street to the boardrooms themselves. If you want to get it for free, email me, or I should say email us, questions@stockmarketmedia.com, and we'll get you on the list for the Daily Hot Corner Report. And we also do a weekly video every
Let's
Wednesday.
Explain to Todd what it is. Todd, do you know the Hot Corner? Are you familiar with this email?
Yeah, it's third base.
That's right.
Something like that. See, spoken like a true ball player. So the Hot Corner takes the best, the most important transactions from the prior day. These are Form 4s filed by corporate insiders. These are 13Ds filed by hedge funds, congressional YOLOs, as we call them, when senators and House of Reps, buying stock, they got to file. We put that all in one nice little email that gets sent out to us every morning. Call it the Hot Corner. It's fantastic. It's great.
Very nice. Very nice. Nope. Sounds good. Hey, you want an industrial defense name? It's a drone maker. This is a smaller market cap company we've been trading. I've got it up, Spencer. Take a look at this one, AeroVironment. They've been consolidating since 2018. They're getting a lot of good orders. Obviously, what's going on in Ukraine, but there's this. It's like a less than a $5 billion market cap company. If this thing can break this consolidation, this is a monthly chart. If we can get above $100 in AVAV, I think this guy's going to go.
Interesting.
You said $5 billion?
I got to check. It's small. Give me AVAV is
2.4 billion.
2.4 billion. Yep. 15% year-over-year revenue growth. Yeah, it's a small company. They just had some good news coming out. They're building out their offerings, and unfortunately, in today's very testy geopolitical sort of environment, I don't know. I'm watching this guy. Small company could go.
Okay. Keep an eye on it. All right, now let's talk about chart report real fast. We have a couple of good ones in here. You guys are the chart experts. I'll ask you. How should I feel about charts like this, right, from Joseph Fami, that just compare different time periods? Again, like, should I? I've always thought the macro environment is so different that it's not worth doing a comparison. But I'm open to changing my mind.
I hear your hesitation in the question. I feel the same way. There's several analogs that I've looked at, like overlays. They're fun to look at. They work until they don't work, and then you set them aside. it's a completely different environment. You can't compare 2000 tech to where we are now. But I mean, obviously, this is post 2000. Fine. I mean, I don't know. I don't have a real takeaway. I hear your hesitation, and I agree with you. What do you think, JC?
I think they're all bullshit.
Moving right along.
I mean, listen, I love Joe Fahmy. I mean, Joe Fahmy's one of my best friends. I'll tell him to his face. I mean, I've said way worse to his face, so this would be nothing different. It's not that it's different this time. It's different every time. And yes, the quote unquote, economy might be similar. Maybe the rotation into certain sector leadership might be similar, but interest rates are going to be way different. The dollar currencies are going to be way different. The commodities market is going to be way different. Like, there's so many other factors going into play. And by the way, I mean, you could just observe and use common sense, like all these idiots with their 1929 analogs and their 1987 analogs, and it's like the 2007 analogs. Like, none of them ever work, number one. Number two, these idiots like to choose the most extreme outliers as the analog instead of more normal years, right? So, like, right off the bat, they're choosing like the rarest situations, right? So like the likelihood of a market being like that is like next to nothing. So they've already lost before they got started.
I agree. Markets don't repeat, they rhyme. I think that's the saying that we're all agreeing on.
Yep.
I just had my chart report screen open and I lost it. I wanted to bring up the tweet from Mike Siccardi about the 60-40. I can't find it. Oh, there it is. Okay. 60-40. Who said that's dead? Who said that's dead?
Was it ever alive?
It was until 2022. And I mean, the whole point what we were talking about at the beginning of the show is I'd love to see the 60-40 come back because, again, that would be dropping long-term rates, which would continue the rotation into growth, make the higher valuation stocks easier to hold, but it further inverts the yield curve. And that circles back to what's the short end going to do? What is Powell going to do here coming up on the 26th? I believe that's the day. So that's what keeps me up at night.
The problem with the 60-40 portfolio in an environment that inflation is the worry is that stocks and bonds are positively correlated with one another. So, might as well just call it a 100 portfolio. Yeah. I think that the 60-40 portfolio came out, was quote unquote invented when deflation became the worry, and that was diversification. And in different times, it's not diversification; it's overexposure is really what it is. Not to mention that the 60-40 portfolio does not take into account that third asset class, which is commodities. And maybe for those of you who have a 9 handle on their birth date, Spencer Israel, you guys might not remember that commodities. They have huge secular bull markets as well, right? It's not just stocks and bonds, it's stocks, bonds, and commodities. And the 60-40 portfolio does not include commodities at all. And I think that that's a mistake.
So I think that's going to be key. We did a macro report this week. And the big thing that I think people are not talking about yet, which will be spoken about, is, again, if we're going into a disinflationary 80s period, that commodities will drop. And what happened was in 2000, you guys remember Jim O'Neill, he coined the term BRICS, Brazil, Russia, India, China. They were major producers of commodities and demanders as large emerging markets were coming online. That created a positive correlation with stocks and commodities. Stocks up, commodities up, indicated future growth. Prior to BRICS, there was an inverse relationship with commodities and equities because lower commodities, lower input costs, better margins. If we've seen the top of inflation's going to come off, disinflationary period, I think because you look at where BRICS are, and I can show you charts of that, they are so far behind where American equity markets are currently. I think the BRICS build-out period is over. And I think that may lead to an inverse relationship like the 80s of commodities and stocks boosting margins. So I am not bullish on commodities because of what I mentioned on the BRICS side. And I think we may be into a disinflationary, lower input, better margin. So watch that intermarket relationship of CRB, 10-year yield, and equities. I'm thinking that bond yields, commodities move down, stocks move up. That's kind of be my long-term play.
And let's remember what Todd's talking about the BRICS nations, Brazil, Russia, India, China. You can add South Korea and South Africa if you want to add a KS to the BRICS, right? But nevertheless, it's really the original BRICS, BRIC, a lot of commodities there. It's really a lack of growth stocks, right? So in an environment that we've had over the last 13, 14 years where growth stocks have been secular leaders, the countries without any exposure there, BRICS or otherwise, are going to underperform. Look at the United Kingdom, for example, is flat for 25 years. You know what their index weighting in technology is? It's 0.0% technology. So if you're wondering why UK can't get going, it's because they don't have any growth.
Yeah, for sure. And if there's a BRICS index. I have this somewhere over here. It's right up on the screen now, Spencer. If you look at this Dow Jones BRICS 50 index, I don't know why. Come on, Adobe. You're a big market cap company. Why isn't it easy to use your stuff? So this is BRICS Dow Jones 50 index going back over 10 years. I mean, it's just sideways. It's sideways. I mean, we had the 2000 to 2010 build out in BRICS. It's just gone nowhere. And then if you look at the rotation here, this is the quarterly benchmark to the S&P. That BRICS 50 just got denied from the right half, which is outperformance of the S&P, and is heading strong south. So again, I think if it's a margins recession, you mentioned it earlier, Spencer, I think if we are going into disinflation, I can show you other charts that might help boost margins and justify these higher valuations. And again, I'm trying to get on the fundamental side, be able to speak their language to confirm what we're seeing technically.
Yeah, I mean, I don't know. Maybe I agree with everything you just said, and sometimes I guess they call that sequence of return risk, right? When you have a great decade followed by a not great decade, and it's, maybe it still looks great in the aggregate, but it's hard to watch something do nothing for a decade.
Yeah, that's for sure. That's for sure.
It's not hard if you don't own it and don't care.
Well,
exactly.
And I don't own it and I don't care. Let them all go to zero. I don't care.
Yeah, that's true. That's true. Okay. So before I forget, guys, Chart Report is a free daily note, goes out every single day, highlighting the best charts on Twitter. If you want to get it, you can click on the link in the description, or you can scan the QR code on the screen, and that's how you get the Chart Report. All right, it is 9:48. What else was on? I know there was a bunch more on my list. We're not going to get to all of it today. Which is
before we get into recess, I know we're getting a question on the chat about Charles Schwab. Throw in there slide 2.
Nice move higher in Schwab. I did not believe in this sell-off in Schwab.
That was a banking crisis related, right?
Right. Yeah, they moved a bunch of.
Did anybody actually believe that was a crisis? Get out of here.
Well, no, hold on. But I agree with Todd's point, though, right? Did you really think that Schwab was in the same class as First Republic?
No, in the whole thing, they're saying this is another GFC. Get out of here. Your GFC was leveraged over-the-counter, synthetically created mortgage products that the leverage exposure was larger than the market capitalization of the largest banks holding them.
Lehman Brothers was leveraged 50-1, bro.
100%. What I'm saying is this: when people are drawing parallels to the GFC right now, it's dude, you're talking about banks that moved short-term U.S. Treasury, the safest products in the world, to another account, and they had to realize the losses because rates went up. That you're talking about synthetic bombs that were developed based on mortgage compared to short-term Treasury paper. And Schwab, I run an RIA, wealth management. We custody everything at Schwab. Clients were asking me, you worried? Not at all. And stock was up 12%. They're the largest RIA aggregator. I mean, they're going to have more assets under management than Fidelity, certainly Interactive Brokers.
Todd, were you legacy Schwab, or did you go on over through TD?
I tried to get on TD when I launched the RIA, and I was the last 2 months, I talked to my guys at TD, they're we can't take you unless I'm pulling in 200 million. They're we can't take you. You got to start with Schwab. And I was okay. I did a TV show with Schwab and CNBC for 5 years. So I've got great relationships with them. And they've been great. they're crazy with going through this TD merger. They're taking on Thinkorswim. They're going to relaunch that. But they've been great to work with. And I got some.
I heard it's not the nightmare that some people expected it to be, that merger.
It's been fine. I mean, we're a startup REA and going through the paces, and I'll be on the phone for 3 hours with one of the customer support. It's been good. No concerns. I'm happy to see the stock up, but I wasn't overly concerned.
Throw up the HSBC. This is the one we own. I'm a big fan of relative strength, Todd.
Yep.
You may have heard of it.
I've heard of it.
Yep. And the fact that people were telling me it's a banking crisis, and I got HSBC making new 52-week highs. That was enough for me. So we are HSBC breaking out of a nice base, making new 52-week highs. I mean,
that's solid.
I don't know what kind of banking crisis people think we're in. The data suggests the exact opposite of that. To your earlier point. Yep. A $1 billion bank, couple of $1 billion banks that no one's ever even heard of. Like, who cares?
I mean, the regional banks are coming back. I mean, even the regionals. I love watching the KRE and KBE every day, even though I'm not really trading them. I mean, just small caps are rallying back, and what's a heavy concentration within the small cap? It's financials. I mean, take a look at Zion, ZION. I mean, this one really got clocked.
Well, it's up 10% today, Todd.
Oh, it is. It was the most perfect inverse head and shoulders. I meant to put the trade on yesterday and I didn't. It's up 10% today. Awesome.
Yeah.
Great. Missed that.
Take a look at first of all, take a look at slide. You got that slide up there with the bank, slide 16. Throw that one up there and then throw up the one next to it.
Exactly. Really just inverse head and shoulders. And KRE is even more pronounced than that head and shoulders.
Yep. And then look at the next slide. This is the old Bank of the Ozarks. Zoomed out. Look at this. Tell me that this looks like.
That's not bearish.
That doesn't look bad, dude. It doesn't look bad.
No, there's some financial names I'm definitely interested in. That looks solid.
Bank of the Ozarks. I tweeted that out yesterday. People thought I was joking.
I was gonna ask you, where do you think that bank is, JC? But it's on there. So.
Yeah, where else would it be? Right. It's not in New Jersey.
The Ozarks are a big place, man.
You guys like the show?
Yeah, big fan.
I haven't caught up. I'm a few seasons back. I started having twins, and my Netflix days are behind me. I think for now, anyway.
My boy from Queensbury, his brother wrote it, and they're the production company for Ozark. Upstate New York. Yeah,
nice.
That's cool.
Yeah.
Can we do a little recess there, Spencer?
Yeah, we can do some recess. There's other questions in the chat that I wanted to get to. I think I covered the ones. If you have any tickers you want us to talk about, we save them for Chart Request Live, 1:00 today. Shoot me an email, questions at Stock Market Media, and we'll do our best to cover all the tickers on CRL later on in the day here. But let's do some recess. Yeah, it's getting late in the hour here. So, Todd, if for recess, what we do is we just talk about whatever the hell we want to talk about that is not markets related. If you got
we've been doing that the whole show, Spence.
And sometimes we do talk about the markets, by the way.
Sometimes we do, but whatever cool thing you got going on in your life or anything you want to plug or whatever, that's what recess is for.
Throw slide one, Spencer. Throw slide one. A little throwback, circa March of 2019. This was probably one of the best days of my life. I don't know about you, Todd. Do you know what picture I'm about to show?
Full screen on this bad boy.
Look at that.
Oh my God. I love that picture.
Oh my
gosh.
It's
a great shot. It's a great shot. John Nigerian over on the left, Todd Gordon in the middle, JC trying not to tumble over there on the right.
Todd's form is extremely good.
It is.
Look at his knees.
I know. It's true.
Yeah, I got the video when you and I are racing, JC. Oh my God, I will put it up. It's so fun.
So we got a cat. Who paid for that? I think it was Yahoo Finance. Maybe it was Investors Business Daily. One of those two paid for us to go on a cat getting taken up to all fresh tracks all day. Dude, that was sick.
Dude, it's so much fun. And I did it 2 years ago. We just booked a cat skiing trip up in northern British Columbia. I mean, There's so much snow, and it snows so often. Helicopter skiing won't work because the helis can't ski. You can't fly, so they bring you up in cats. And like we're looking at trees that are like this high off the ground, and our guides are like, that tree's 25 feet tall. We're like, what? Like you ski down in the woods. We did some tree skiing, JC, and Breckenridge up here and up there in BC. There's something called tree wells. This will scare you. This is what nightmares are made out of. So the snow falls and pushes, the branches push the snow away, and it doesn't fill in around the base of the tree. So you can look down and you'll see like 10 or 15 feet straight down, like 12 inches around the outside of the base of the tree. So if you're skiing and you fall and you go head first, you're going down 12 or 15 feet head first down into a tree well. So you got to wait about an hour for them to rescue you.
There was a video that went viral a couple months ago.
Yes.
You saw that that backcountry skier that just found his snowboarder trapped in a tree well.
100%. And he's lucky because he went feet first, so he was kind of hanging on with his life. If you're skiing hard through the trees and you go forward, a lot of times you'll go head down and you may not get out.
Yeah, scary stuff. Okay, so JC, was that your recess? Was skiing?
I mean, I found the picture. It was a good time. We obviously awesome. Need to do it again. But let me ask you this about British Columbia, because as much as I love Whistler and Vancouver and all that stuff, man, it gets cold as hell up there. So are you talking like January, February? You're talking about March, April?
It was crazy. We went 2 years ago, and this was, I don't know if you remember our winter 2 years ago, it was like 0 multiple days in a row here on the East Coast. It was 30. I mean, we were so hot. It was not bad at all. It's just gorgeous. I mean, this is the website that we're launching here, but this is screens up. This is British Columbia. It's just ridiculous. I mean,
Is that your wife?
That's funny. I wish it was my wife. No, come on, bro. Yeah. So it's fun.
Is that you?
Yeah, man.
Dude, they're getting some serious air there, bro.
That was coming off of
is that Photoshop? Are you Photoshopping that?
No, I got the video, man. That was coming off a 360 too. That was at the end of a 360.
Wow. Now you're just showing off.
Nah, listen to me. That's what, this is what we need more in money management, is taking, to Spencer's point in 60-40, we're active portfolio, active management. You have the index, you have the average. I think the averages are for average investors, man. You're holding, a lot of stocks that are not performing. You've got to watch rotation. You got to hold the right stocks. I think what we're doing, and specifically technicals, are gaining a lot more respect that they deserve, because there are stocks that are working and there are stocks that are not. And it really doesn't pay to hold the stocks that aren't. Everything we're doing is super, super important. It starts at the highest macro level, talking about rates, and down to rotation and following the right names, and then position sizing. Like our work is very, very important.
To Todd's point, throw up their slides 1 through 3 there. I think in the back half of this year, exactly what Todd was just saying, I think there's going to be winners, and I think there's going to be losers. When in bear markets, correlation spike, VIX spikes, correlation spike to 1. And as bull markets progress, we're now in month 14 of this bull market, and you're seeing, go on to the next ones. This is the 1-year correlation between S&P components. This is the 6-month correlation. Take a look at the 3-month correlation, completely collapsing.
Yep.
That as that progresses, that puts us in an environment where there are both winners and losers, not everything goes up or everything goes down, which is what 100%. Happens in times of volatility. So I think there's winners and losers. To Todd's point, the way I learned it from a wise Egyptian man many years ago was that if you trade the averages, you're going to get average returns.
Yep. No, that's it. That's such a good point. As the VIX drops, volatility drops, complacency sets in, and that's when markets start to wander. And then you have the haves and have-nots. We settled into a 12 or 13 VIX regime. I mean, a couple of years ago, it was 10. I mean, we could go 30% lower in volatility here, and that's just going to further increase the wandering of markets. And, that's important.
Quick, Todd, this is for you. We got 1 minute left. Sorry if I'm stealing the thunder here, Spencer, if you had a recess. But since we have Todd is an expert in options. We haven't even talked about options at all. Actually, you mentioned a butterfly. Barely talked about options. When I see a low volatility environment like we're in, I see the VIX at 14 or whatever it is these days, maybe even lower now.
Yep.
I want to put on strategies that benefit from low volatility environments, right? I don't need to finance my options trades. You know, like if I like a stock, I could just buy calls, go as far out as possible. I don't have to sell puts against it. I don't have to sell further out of the money calls. There's no reason to do that. I'm not getting paid to do that. You can just shut up and buy calls, as opposed to in a high volatility environment, you're paying a fortune for those calls. So you got to finance it by selling some out of the money puts, some further out of the money calls, something like that. Can you talk, poke some holes in that?
Yeah. You know, it's interesting. I mean, okay. So to your point, if there's a high volatility market, if the VIX is, let's say, north of 20, option premiums, both puts and calls, will be more expensive. But the reason you're paying for it is because think about what increased volatility means. There's more movement. And the more volatility that's priced into the option, the better chance that those strikes will be met. Right. So there's better chance that those options will go into favor. If in a low volatility environment where there's not a lot of movement and we're just slowly chugging higher, a lot of options will expire worthless just because the very nature of volatility, there's not a lot of price movement in order for you to actually go and see your option go in the money. So you can look at it, you know, one of two ways. You know, so, you know, if you want to just buy calls in a low vol environment, sure, that's fine. I would just
puts, or cheap puts.
Or cheap puts. You know, I think if you're looking to do like a stock replacement, what I would do, and I can show you an option chain. You know, if you're looking to do longer term, be sure you're not buying out of the money options in a low vol environment, unless you feel really strong about a name that's moving, fine. But just as I said, the lack of price discovery in a low, say sub 15 VIX environment gives you a pretty good shot that those options aren't going to go in the money unless you're really, really right in direction. So the only thing I would say is to guard against that is rather than buying a Delta 30, Delta 20, which is out of the money option, buy like a Delta 70, which is like in the money already. Buy something, even if, you know, stocks at 100, don't be afraid at, you know, buying a $90 call that has some intrinsic value. So it's a higher delta. It's going to cost more. You're still using the leverage. And if time is working against you and you're not getting that price discovery, you're not going to lose as much as if you loaded up on $120 out of the money calls. I hope that makes sense.
100%. Also, what about, to your point, what about slightly out of the money calls, right? So not like super out of the money. Like when HSBC, we bought the 40 calls, I think when the stock was at 38. Do I have that right?
Yeah.
Something like that, 38 and a half. When we bought the 30, the 40 HSBC. Yeah, that sounds right. So it was in the high 30s. We bought the 40 calls. They're now $1.50 in the money.
Yeah. What'd you pay for them? Do you know?
I think like $2, $1.80, something like that.
So 42 is going to be your break even. Yeah. That's, I mean, listen, it's absolutely fine. I mean, I use it all the time.
January.
Okay. Yeah. You know, a big component, you know, a lot of, you know, I was listening to what you're saying. This is a longer conversation on the 60-40 portfolio. Why bother? And, you know, one of the things that I've learned as I'm running into money is, you know, when guys, doesn't matter how smart or successful you are. And I haven't worked with a lot of females. I'm just saying, guys, you know, when you start moving out of your income earning years, even though you're smart and you made a lot of money and you're aggressive, the idea that you're losing your ability to make money changes. And there's a psychology that comes in. And the reason I'm kind of going down this path is rather than go into fixed income, which is a good return right now, still below inflation, we use options. So I'll do downside put spreads every quarter in the S&P, you know, and for guys, again, who want to be involved in the market, but you know, are afraid that we are going to get clocked here, you know, as you're moving into your latter years. So using downside, use the SPX, you know, we'll go down 5%, buy the put, sell down 20%, do it quarterly. And the great thing about options is you can budget in what that cost is. And you know exactly if the S&P is at this price at the end of the quarter, what your drawdown will be, how much you're protected. So options are a great way, to your point, hedging. Hopefully you don't need them. They're insurance policy. And I think in this market, you know, a lot of them, those insurance policies are worthless, but that's what they're for. Options are a great way to protect, and they're a good fixed income replacement.
Yeah, this could be an hour-long conversation. Unfortunately, we don't have an hour. We've already been on for an hour and a half. A huge thank you to Todd Gordon for coming on the show today, for co-hosting. We appreciate that very much, Todd. You can, if you're, you know, Todd's handle is on the screen. If you don't follow him on Twitter, you should. Links to his site are in the description as well. So thank you to Todd. Thanks to Kimmy. Thanks to all of you in the chat. If you want to just throw me a bone and hit the thumbs up, that helps us in the eyes of that all-powerful YouTube algo. So I'd appreciate that. Stay tuned. 1 o'clock today, Eastern Time. Chart Request Live. Myself and Patrick Dunawilla. So that's it. Everyone have a good rest of your day. Go make some money. Todd.
Go get 'em, buddy.
Thanks for having me. I appreciate it very much.
Call me for golf. Let's go.
All right. I'll be down.
All righty.
See you, boys. Thanks a lot.
Running, I can't take no loss.